In this video, let's talk about discounted cash flow models. We did a very simple discounted cash flow model in video 2, where we invested $1,400 to get $1,000 per year for the next 4 years. We used the NPV function and made sure to use it correctly by pulling the time zero cash flow out of it. And we found the net present value. That is, what is this entire project worth to us today? What profit does it generate at a certain discount rate? We also found out the discount rate that would make that net present value equal to 0, and we call that the rate of return using the IRR function. This happened to be a model laid out in kind of a horizontal layout, if you will. We could do the same exact problem with a vertical layout, same numbers, same answers. What I'd like to do in this video is expand on this a little bit and think of it as more of a generic discounted cash flow model, where we look more deeply at where some of these numbers might typically come from. Now we could do different types of these. If we were doing this work in a corporate model, we'd typically call it capital budgeting. In a real estate sense, we might consider it a residential or commercial property investment. In an energy context, we might think of it as economics of drilling a well. And in a strictly investment banking context, where we're dealing with pro forma models, we might call it a DCF. In that context, DCF means discounted cash flow, but it has a very specific meaning where we're looking at the free cash flow from a firm. We're going to put this off until later, and today we're going to focus on these 3 applications. So in each application, let's assume we're looking at ATAX net cash flow. And this means whatever is going on with our capital budgeting project, if we're buying or some equipment or building it, if we're investing in some commercial real estate, if we're drilling a well, we're likely to have some kind of investment and revenues and expenses and depreciation and taxes and things like that that ultimately get us to this ATAX net cash flow, which means this is no longer an input. And in fact, these will be formulas that sum up all those things I just talked about. So from its most basic, we could think of this model as some type of an investment. It could be the purchase of the equipment, it could be the drilling of a well or the investment in the property, from which we hope to get some revenue and should expect to pay some expenses. And let's do an intermediate stop at that point and get a before tax cash flow. And so in this case, we said our investment was $1,400. We wouldn't have any revenue or expenses at time 0, but we would in year 1, let's say. So perhaps our revenue was $1,200 and our expenses were $200, and our before tax cash flow would represent the investment plus the revenues minus the expenses. And if I'll show my outflows as negative and my inflows as positive, then I can just use the sum function to take care of those. Let me copy these down and copy this formula down. And we have the same numbers here for before tax cash flow as the original in the example that gave us these outputs. But that's not necessarily going to be our ATAX net cash flow. So I'm going to delete that for now. Now, depending on the type of investment, we might have some depreciation, depletion, or amortization. Right now, the tax laws are such that in an energy context, I can drill that well and write off the entire cost of that well in the first year. That won't be the case for different types of projects, but let's do the simple one first. My taxable cash flow then becomes the sum of my revenue less expenses less the DD&A. That's my taxable cash flow. If I know a tax rate, then I can calculate the taxes. And the taxes then are equal to an outflow of the taxable cash flow, which already is an outflow in this case, times the tax rate with absolute value. And so in this case, where I'm spending money, I'm getting a tax shield from it. So I actually get money back on my taxes. Now, we won't get into the accounting nuances of that. We'll assume that elsewhere in the firm, we have taxable income to offset. But if it works out that way, then my after-tax net cash flow is just my before-tax net cash flow plus the taxes. So I spent $1,400. I got a tax break of $280, and that left me with a net of $1,120. If I copy these formulas down, I've written off the entire investment in the first year, so I don't have any DD&A after that. My taxable cash flow after that is simply the revenue minus the expenses. The DD&A is 0, and the taxes are 20% of that taxable cash flow. And then the A-tax net cash flow is the before tax less the taxes, which gets me to the $800. Notice that the net present value went down because we had to pay some of our profit in taxes, but the rate of return didn't change. The discount rate that would make this NPV 0 is the same whether the tax rate is 20% or whether it's effectively 0 as it was in the earlier problem. That's because we just reduced all of these cash flows by 20%, whether they were positive or negative. We reduced the magnitude of them by 20%. We were able to do that because the DD&A on this particular investment, in my example, drilling a well, was all able to occur at time 0. With other types of investment, we might have to depreciate that over a certain number of years. Those tax laws change, and we won't get into the specifics of it, but let's assume that we're doing a capital budgeting project where we're buying or building some equipment for $1,400, and we can depreciate that amount over 3 years. Now, I'm going to break some modeling rules just to illustrate this. We'll come back and get a more elegant way to do the DD&A following the modeling rules. But for now, let's say we don't have any in the first year. I'll hard code a 0. And I'll say in the 0th year, we don't have any. In the first year, we have the investment, and I'll put absolutes divided by 3 because I'm going to copy that down, paste, and then I'm going to hard code another 0. And now our depreciation goes into the future, which means the tax shield from it is pushed into the future, which pushes our net present debt value down and also pushes our rate of return down. That's because we have to wait longer to benefit from the tax shield provided by the investment. This would be a great time to hit pause, recreate this table, and make sure you understand what each of these columns mean. We're investing some money up front. We're enjoying some revenue, paying some expenses, netting that out, and so that's what our checkbook looks like, but it's not what our taxes are based on. We get to base our taxes on the revenue minus the expenses minus whatever depreciation we get to take, which is not the entire investment in the first year necessarily. We use it to calculate a taxable cash flow, and therefore the taxes, so that our after-tax net cash flow is based on the before-tax cash flow minus the taxes. I'm assuming that you understand all of this from your previous finance and accounting courses. If any of this is new, then please contact me right away and let's talk through it. As I look back on the video thus far, I realize at times I've said we are taking B-tax cash flow less taxes or plus taxes or what have you. The way I've got these cells formatted, any outflows are in red, any inflows are in black, and most of my math uses the sum function. If you will stick with that convention where your outflows are negative, your inflows are positive, and you're adding things with the sum function, and notice we can use a full range like I did here, or we can use commas inside that sum function. If you'll do that, you'll never have any problem with signs. If you come over here and start saying, well, do I take the B-tax cash flow and add or subtract the taxes? Then I promise you'll get confused at some point. So I'm going to change this one to say sum. of F10, comma, I10. That guarantees that I treat the signs correctly. So I'll copy that down. Another thing I'm going to do is sum some of these columns. You may recall that Alt equal will give us the sum quickly. And I want to point out that the sum of the before tax cash flow is exactly the same as the sum of the taxable cash flow. It just has to do with timing. Because of the depreciation schedule that we have to use, this investment gets pushed into the future, and so our before tax cash flow is actually front loaded relative to our taxable cash flow. And that has to do with why these numbers were changing as we use different depreciation schemes. And then finally, I want to remind you that I broke some modeling rules here. This is not super elegant to come in here and divide that by 3 years. There's nothing visible in this model telling us that we're on a 3-year depreciation schedule. We have a very elegant solution for that, but I'd like to save it until later in the course. And for now, we'll just go ahead and kind of brute force these depreciation schedules in. Now, one more thing I would like to do before I leave this section is what I call a revenue build. And before I do it, I'm going to rearrange some of these cells and align these to the right so that I can insert columns here. I don't want those formatted as inputs. I don't want these columns quite that wide. How do we typically build revenue? Almost always it's some quantity times price. And so this could be widgets times dollars per widget. It could be units times annual rent per unit. It could be barrels times dollars per barrel of oil. So whatever type of project you're doing, this is really where the differentiation comes in between capital budgeting or property investment or drilling of a well. It's how do we build that revenue? Now you could also come in here and do something with expenses. You might have maintenance and insurance. You might have, and that would be for a real estate project. You might have power and chemicals. For an energy project, you might have operating and maintenance, however you spell the word maintenance, for a capital budgeting project. Now, if you do that, if you insert columns, make sure that you didn't use this sum function over here, because now I'm summing up a whole lot of things that I didn't intend to. I need to go back and apply the appropriate commas there. So let me back out of that and say this equals quantity times price. And perhaps let's go back to the widgets. When you're working on your project, you should adapt your model to probably some kind of quantity and price. You have some flexibility in this model. You may get a little bit more creative than that, but that's probably what I'd recommend. And then several of you may want to have various types of expenses, but you should feel free to add columns in here as necessary to get your revenue and your expenses. And just make sure that the math is working correctly and it gets you down to a net present value and a rate of return. In this particular case, my widget price is constant. So I might want to make that an input up here. That would be what? Dollars per widget, price at which I'm selling them. Copy that. I think we're using $20 per widget, so I'd better type it in that way. And then I could come in here and say equals this with dollar signs. Copy, paste. And so if I were going to build a dashboard, I've got 3 really significant inputs up here that I could tie some controls to and see how the outputs varied. with these inputs. On the other hand, if I were writing a quiz, I've got a model with lots of dollar signs, absolute relative references, inputs, outputs, sum functions, things like that, that I could use to test people over their understanding of modeling rules, goal seek, and data tables. So I hope that gives you a good overview of a basic discounted cash flow model with different applications. Again, in a future video, come back and we'll look at some elegant ways to calculate our DD&A.